Hi everyone, let's talk about Lenskart today. Lenskart is planning to list on the Indian exchanges in the November 10th timeframe. There's been a lot of talk and a lot of interest around this IPO, so let's dive right in. But right at the beginning, I would like to preface that none of this is financial advice. This is purely my thoughts and some of my analysis that I want to present to you. Please do your own research before making any investment decisions. All right, what are we talking about here? We're talking about an IPO with a market cap of about 70,000 crore rupees, which is approximately about $8 billion. In 2025, the company reported a total earnings of revenue of 6,650 crores. The profit was about 257 or 297 crores, but after adjustments, after one-time adjustments, the normalized profit is in the range of about 130 crores. So let's assume that 130 is the baseline. Using that baseline, the net margin for the business is around 2%. So the valuation of the company is based on the valuation of 70,000 crores and 130 crore earnings. The price to earnings ratio is about 536x. 536x. Let that sink in for a moment, and let's think about it in terms of how big that number is compared to some of the other companies that are available in the Indian market or in the global markets today. Now, the company is planning to have a fresh issue of rupees 2,150 crore. That's about $250 million in the IPO. So the IPO that we're talking about here is going to raise only 2,100 crores of the 70,000 crore market cap. There's also going to be an OFS, which is an offer for sale component where existing shareholders, all the institutional stakeholders like SoftBank and Temasek holdings are going to be offloading a bunch of shares, and that's going to be about 5,100 crore. So think about it this way. So there's a bunch of institutional holders and founders like Piyush Bansal who are selling these shares. They sell these shares to retail holders. The retail holders pay them the money. So the money that is being paid to them as part of the OFS, that is 5,100 crores, doesn't go to the company and doesn't go to the company for operations. It instead goes to the owners. It goes to the institutional owners. And that's something that we need to very, very clearly understand the nuance between it. So the total IPO size is 7,278 crore, of which only about 2,100 crore is something that is going to be float or available as liquid shares available to trade for retail investors. So what is the growth that is required to justify a normal valuation in the 25 to 30 range? Let's assume 25, a price to earnings ratio of earnings per share of 25. The current profit we talked about was 130 crores, market cap of 69,700 crores. So the PE we already spoke about was about 537. Now, if you want the PE to go to 25, it means that your earnings multiple, your earnings should increase by a factor of 21 times. So 21 times the current earnings is what we need to get to, which means a cumulative growth of about 2,050%. So if you use the simple compound interest formula and you evaluate what should be the growth required over the next 5 years, it gets us to the answer of 84% annualized CAGR. I haven't heard of any company growing earnings at 84% annually, let alone a company which has been in operation since 2010, which has had a track record of performance. It's a good company, all right, but again, it's not a new technology or a disruptive technology which is going to be changing customer adoption in a significant manner. Now, let's talk about the revenue implication of this. If the current revenue is about 6,600 crores with a net margin of 2%, and if you have to achieve a profit of 21 times the current profit, which is 130 crores, which is close to about 2,800 crores, let's assume that the margins remain constant. The required revenue is about 1,49,750 crores. So that's a huge jump in revenue that would be required for you to deliver on that 84% CAGR number. Now, let's for some reason assume that they drive productivity gains, they drive operational improvements, and they improve the margins to about 10%. Even then, the revenue that would be required to support this valuation, assuming a 25 price to earnings ratio, is about 4.2 times or 4 times the current revenue, which means that the company would still have to grow at a CAGR of 33% over the next 5 years. 33%? Unheard of. Even Nvidia is possibly not going to be, it's going to be hitting a cap in the next few years, and it's not going to be hitting the 33% growth. So my takeaway from all of this is that the math and the numbers don't lie. And the math very clearly points out that the company is highly overvalued. But again, there might be other aspects to the valuation that I do not know of, but the math really doesn't add up. Let's talk about the ownership pattern. Even after this listing, only about 10 to 12% of the Lenskart shares are going to be available for retail investors. This means about 90% of the non-listed shares are owned by insiders and institutional investors. Now, it's very normal for a large majority of the free float of shares to be owned by institutional investors, hedge funds, mutual funds, ETFs, all of them buy stocks on the exchange. But the difference is that Lenskart's in the case of Lenskart is that institutional holders have a lot of shareholding, but they are not available as free float in the market. They've only sold a part of it as part of the OFS, and a majority of it is still held by them privately, and there will have to be subsequent sales for them to get an exit. What's the implication of this for retail investors? Retail investors are going to see a few number of shares. The trading volume that is going to be available on a day-to-day basis is going to be much lesser than you see on a Reliance or an Infosys, or for an international company like an Apple or an Amazon. The daily trading volume is going to be very low, which means that price discovery, price fluctuations could be significant. So you have two factors. You have the free float being very, very low. You have the institutional investors and the owners who have already exited through the OFS and have made a ton of money. And you have the math, which certainly doesn't pencil out even in the most conservative of circumstances. So my only advice to you is that tread with caution. Be very, very mindful of the returns that you're expecting when you're paying so much right up front in some of these IPOs. And remember that margin of safety is the most important concept in finance and investing. Think about what your margin of safety is with such an investment. Tread with caution. Do your own research. Good luck. See you in the next one.